Investing money can assist in the accumulation of wealth. However, taxes can significantly reduce your earnings. One approach to reducing your tax liability and preserving a greater portion of your wealth is to implement a buy, borrow, expire strategy. The concept of buy, borrow, die was formulated by Professor Ed McCaffery in the 1990s as a means of elucidating how individuals accumulate wealth and maintain it. The term has resurfaced in the context of tax inequality and the actions that ordinary individuals can take to alleviate their tax burden nearly 3 decades later. We will delve into these topics in the following section. If you are seeking assistance with your investment strategy, it may be beneficial to consult with a financial advisor. What is buy, borrow, die? The concept of buy, borrow, die aims to elucidate how individuals with greater wealth can preserve their wealth by reducing their tax obligations. According to the theory, wealthy individuals are not exploiting tax loopholes or engaging in fraudulent activities to manipulate the system. Instead, they are reducing the amount of tax they are required to pay by engaging in strategic investing and planning. The strategy is referred to as buy, borrow, die due to the 3 components that comprise it. The concept was devised by McCaffrey to elucidate how wealthy individuals position themselves to pay less in taxes in comparison to the average American. How does a buy, borrow, die strategy operate? The strategy of buy, borrow, die is quite simple once one comprehends the meanings of each of the 3 stages. To gain a more comprehensive understanding of the process, we will examine each phase or component of the strategy individually. It can be done now if you are prepared to be matched with local advisors who can assist you in achieving your financial objectives. Buy is the initial step. The phrase purchase is exactly as it sounds. A portion of your wealth is allocated to the acquisition of assets that are expected to appreciate. Assets that are worth appreciating include asterisk stocks, asterisk real estate, asterisk work of art, asterisk exquisite vino, asterisk additional collectibles. This is done to leverage the appreciation of those assets as time progresses. In contrast to vehicles and other forms of real property, real estate, for instance, has a propensity to increase in value over time. Additionally, property ownership may serve as an effective hedge against inflationary pressures or stock market fluctuations. Moreover, the acquisition of real estate may result in tax benefits if the depreciation is deductible. Additionally, you may generate current income by leasing a rental property on a seasonal or full-time basis. It is preferable to acquire assets that will increase in value on a tax-deferred basis and generate passive income. Passive income is money that is not earned through labor. For instance, dividends generated from securities are an additional instance of passive income. Section 2. Borrow. After purchasing assets that are expected to be appreciated, the subsequent action is to borrow against them. In other words, you utilize those assets as collateral for loans. Why would you choose to do that? Leveraging assets as collateral enables one to borrow money while maintaining the value of the underlying assets as per the buy, borrow, perish strategy. Instead of selling investments for cash and subjecting yourself to capital gains tax, you have the option to borrow against your assets. Here, there is a double tax benefit as the loan proceeds are not considered taxable income and you are not responsible for capital gains tax. Certainly, it is crucial to employ the appropriate assets as leverage for a loan. Again, this is where real estate ownership can be advantageous as it can be utilized as collateral to obtain loans. Conversely, withdrawing funds from your retirement account may result in a tax penalty and deplete your assets. For instance, when you obtain a 401k loan, you are borrowing from yourself. However, the funds you withdraw are not compounding on a tax-deferred basis. In the long term, this can undermine your wealth-building strategy. The IRS considers the entire amount as a taxable distribution if you are unable to repay the loan, which poses an additional risk. Section 3. Death. Wealthy individuals comprehend the significance of estate planning and the disposition of assets upon their passing, even though contemplating mortality is not an enjoyable experience. Minimizing estate tax is frequently a top priority, as it can enable you to bequeath a greater portion of your wealth to your loved ones. In acquire, borrow, die strategy, the beneficiaries of your estate may utilize a portion of the assets you have left behind to settle outstanding loans. This enables them to circumvent the necessity of making personal payments to satisfy their debts. Furthermore, your successors will receive a step-up in the cost basis of those assets upon their receipt. They can circumvent any capital gains tax that is owed on the sale of assets they inherit as a result of this upgrade. The alternative is for them to retain the assets and refrain from disposing of them. If they elect to pursue that course of action, they may continue to implement a buy, borrow, expire strategy for themselves and the subsequent generation of heirs. Is the buy, borrow, die method truly effective? For individuals who possess the ability to adhere to it, a buy, borrow, expire strategy may be an effective approach to reduce taxation. Purchasing assets that are appreciating enables you to capitalize on their long-term appreciation in value while also potentially generating some current income. Your assets can be utilized to obtain loans that are not subject to taxation. The primary disadvantage of the buy-borrow parish strategy is that it necessitates a specific sum of money to capitalize on this strategy. For example, an individual with a net worth in the 4 or 5 figure range may not possess the necessary resources to acquire assets that are expected to be appreciated. For an individual with a net worth of $1 million or more, this may not be a concern. In simpler terms, the buy strategy necessitates wealth to generate wealth, which is not feasible for the majority of individuals. You may already possess an asset that is appreciating if you own a residence. However, your financing options may be restricted to a home equity loan or line of credit. If you are unable to maintain the payments, utilizing a home equity loan or HELOC to access funds can be problematic. If you fail to repay the loan, the lender may commence a foreclosure process against you. If the worst-case scenario occurs, you may lose your sole asset, which is appreciating. In conclusion, as you accumulate wealth, it is permissible to implement the buy-borrow-die strategy to reduce your tax burden. Nevertheless, the implementation of this strategy may prove challenging if you do not possess an abundance of financial resources. In the interim, you may pursue wealth accumulation through conventional methods. For instance, creating wealth on a tax advantage basis can be achieved by maxing out your 401k or opening an individual retirement account IRA. Advice for estate planning. It may be advantageous to consult with your financial advisor regarding the feasibility of incorporating buy, borrow, and expire into your financial plan. Additionally, your advisor may be able to provide additional suggestions for reducing your tax liability by investing in tax-efficient vehicles. If you have not yet secured a financial advisor, the process of locating one is not overly complex. The free tool provided by SmartAsset matches you with up to 3 financial advisors who are located in your area. You can assess your advisor matches at no cost to determine which one is the most suitable for you. Be in the process of identifying an advisor who can assist you in accomplishing your financial objectives at this time. When developing an estate plan, tax planning is merely one factor to take into account. It is also crucial to consider how your assets will be transferred to your successors. Creating a will is a fundamental component of estate planning. However, it may be advantageous to investigate the advantages of establishing a trust. Life insurance requirements and the establishment of supplementary revenue sources are additional factors to contemplate. For example, an annuity can be a reliable source of income during retirement, preventing the need to deplete other assets. Don't forget to like, subscribe, and drop a comment below. We'd love to hear your thoughts and stay tuned for more content.